Whether you're a small business owner or looking to start a business, chances are you're going to need a loan. Whether you require lending for your real estate transaction or another aspect of your business, receiving funds up front from a bank can get the job done. But with a variety of options available, how do you identify the best option for you and your business? In this video, I will review the two most common types of loans, conventional and SBA. The goal is to help you understand how and where to start your loan process, weigh the pros and cons of conventional versus SBA, and what to expect along the way. I'm Remy Isdaner with Mirlo Real Estate Partners, and I'm here to help you make important real estate decisions for your business. I'm a commercial real estate agent specializing in tenant representation, and our channel can be a great resource and starting place and for you to prepare yourself for real estate transactions and other related choices. As a commercial real estate agent, I have represented a wide variety of business types, from restaurants to doctors, software companies, and warehouses. I have guided my clients through new leases, lease renewals, building purchases, and relocations, so I'm very familiar with how to secure funding for various project types. Before we get started, if you are new to our channel, please be sure to like, share, and hit that subscribe button to get notified on all of our videos so you can learn more about the commercial real estate world. First things first, let's break down the concepts of a conventional loan versus an SBA loan. A conventional loan for your business is very similar to a conventional mortgage loan you would get for your house. It's a sum of money provided by a bank or credit union, which is to be paid back by you as the business owner with interest and over a set course of time. An SBA loan is also provided by a bank or credit union, includes interest, and is paid back over a set period of time. However, it also involves the government agency known as the Small Business Association, or SBA, who essentially guarantees the loan for you. In other words, they mitigate the risk for the bank because depending on the specifics of the loan, they will back 50 to 90% of the loan on your behalf. Therefore, if you don't pay the loan back, the bank will only lose out on the remainder of the loan amount, making the loan much less risky. The purpose of SBA loans is to help small business owners get approved for loans that they would otherwise not qualify for, because they might appear too risky for a bank to take them on. And with that idea in mind, we can get into the differences between the two. Conventional loans for businesses have a reputation for being difficult to secure. The approval rate hovers around 25%, and being approved can sometimes take months. Because business loans are relatively large sums of money, banks tend to be very cautious. So how do you know if you even have a shot at being approved? Well, there are a few big factors. First is how long you've been in business. If you are a new business without a long track record of financials, that alone might disqualify you from being approved for a conventional loan. Second is whether your financial track record is positive or not. A long-standing business with a poor payment history or credit score is not likely to get approved either. Another factor considered by the bank is your personal financial history. A long-standing business with good credit and a reliable payment history might not be enough if your personal financial house is not in order. The bank wants to know that you, as the business owner and decision maker, pose a low risk too. Other considerations for the bank are going to be how profitable the business is, how much collateral you can provide from current assets, and ultimately, how risky your project is. By way of example, a new real estate development is considered more unpredictable than leasing space in an existing building. Funding the development is a much riskier endeavor for the bank and will be scrutinized as such. So far, this doesn't sound like much fun, and you might be wondering why a business would go through the hassle of a conventional loan. What's the benefit? It's simple. Conventional loans have a wider range of terms and options, and if you have a long and strong financial history, you can be approved for a larger loan amount with a lower interest rate. And while the process takes time, it's still faster than the SBA route. To that end, let's shed some light on SBA loans. These loans have strict guidelines and certain limitations, which should come as no surprise since they are part of an established government program. However, their purpose is to provide lending opportunities for riskier businesses that banks might otherwise pass on. As a result, they are reliably easier to get approved for. The most common SBA loan is called 7A, which has a loan cap of $5 million and is considered their standard loan variety. Smaller loans are also offered under the 7A category and cap out at $350,000 and $500,000. The interest rates for SBA loans can be negotiated either by the bank partner who is doing the actual lending or by you as the borrower. but there's a maximum SBA interest rate set by the government, and it won't ever exceed that amount. SBA loan terms can also be up to 25 years, which helps lower monthly payments for your business. Providing a lower monthly payment is one of the greatest advantages of an SBA loan, especially if your business is fairly new. And while certain credit standards and requirements exist, the prerequisite for a long and strong financial history is less important with SBA. If you're asking yourself what this all means and which option is best for your project, we recommend looking into both options. For more information on SBA loans or when you're ready to apply, visit their website at sba.gov. You'll also be able to verify which lenders are able to provide SBA loans. Once you understand which banks offer the SBA loan you're looking for, you'll be able to compare each bank's conventional loan packages against the SBA loan terms they offer. But before you apply for a loan, be prepared. Make sure you've gathered all required financial documents, and make sure you understand your financial situation fully. For more information on the financial documents you'll need to apply for a loan, check out our other video covering this topic. The link is in the description below. Commercial real estate is incredibly complex, and if you aren't an insider, good information is hard to come by. In my practice, I'm always learning and growing, and I strive to serve my clients and provide them with the tools to make the right decisions for their business. So if you have any specific questions or comments about anything I've shared, please feel free to contact me directly by email or phone, or leave a comment below. If you found value or liked the video and would like more information about how to properly navigate the commercial real estate world, check out our other videos. Again, I'm Remy Isdaner from Mirlo Real Estate Partners, and I can't wait to connect with you again.